And then also, I'm going to put up on the screen a chart that shows what the markets have done over history. And to show you how different last year was, on the screen, there's a chart that shows the stock market total return, either positive or negative, and then the bond market total return, either positive or negative. And if you can see in the upper right quadrant, most of the dots are in the box where it says the stock market was up and the bond market was up, and each dot represents 1 year. So most of the items are in this upper right box. That's the normal condition of the markets. Usually stock market's going up and the bond market is giving positive returns through interest and not losing value. Then if you look at the upper left, that's where the stock market is down, but the bond market is up. That's the second highest distribution of returns, but significantly less than the double up. And then over to the bottom right, we see 5 years only where the bond market was down. The bond market generally doesn't go down very much, but the stock market was up. So this little box over here on the lower left, which means both the stock market and bond market were down, only had 0 instances up until last year. So last year was the first year in which both the stock and the bond market were down in American history, or at least in modern finance industry history. So now we're looking at, why did that happen? Of course, interest rates spiked up so sharply that the bond market really literally collapsed. And it was the worst bond market on record in American history, down 12%. The stock market was down close to 20% on the broad index. And then the technology index down 33. Many of the big tech stocks were down even more. So it was a very, very rough year for investors.
The personal consumption expenditures price index, which is what the Federal Reserve really likes to use for their inflation measure. It's known as the PCE price index. It rose 5% in December year over year, and that's a slowdown from the 5.5% year over year increase in November. So about a 0.5% slowdown there. So we continue to see that inflation number slow down slightly, although their target, the Federal Reserve's still stated target is 2%. So that's still 3% above where they would like inflation to be. The producer price index rose 6.2% year over year in December. That was the slowest annual rate of increase since March of 2021. So that's positive. That means on the supplier side, we're starting to see costs come down. Usually that gets translated to the purchasing side or the consumer spending side. So on both fronts, really, we're seeing inflation continue to slow. Most of that was expected. Maybe we'll see spikes here and there, but overall, the trend has been down with it. Purchases at stores, restaurants, and online declined a seasonally adjusted 1.1% in December from November, so month over month. And then spending by U.S. households decreased 0.2% in December from November. So that's that trend potentially impacting the GDP coming into Q1 2023. If those trends continue and consumer spending, household spending continues to move downwards, that is going to have a big impact on GDP. And I think one important thing to point out, Brian, like you said, recessions, if you will, are cyclical. So we have, markets, most likely if we're in a recession now, we have the earnings coming out now. And we were kind of projecting this a little bit kind of towards the end of 2022 that we really need this earnings adjustment period. And that's what we're seeing now. We're seeing a lot of bad earnings, a lot of bad projections. So what's going to start to happen is then the next earnings cycle, so Q2 and then even into Q3 of 2023, we're going to start revising those earnings down. And then once they get revised down, and hopefully at some point base and start moving upwards again, that's when most likely we'll start to see the market bottom potentially and start to move upwards strongly. So, but on the flip side, like Brian's talked about, is not every area is getting hit. Chipotle, in fact, plans to hire 15,000 people in the U.S. as they're seeing their business increase in the coming months. So, each sector, I know restaurants even, each sector isn't getting hit equally, if you will. So really interesting on that front. And one other thing I'll mention is Bed Bath & Beyond, which we've talked about here, as getting close to bankruptcy. They're kind of dwindling back and forth. Well, they've been cut off from their credit lines as several other banks have determined they've defaulted. The government filed an antitrust lawsuit against Google this week, trying to compel the company to divest part of their advertising technology unit, which back in 2021, this unit comprised about 12%, so a decent chunk of Google's revenues. So, and this has been an ongoing thing. I think that it's still going to continue to be in the limelight, that you have these massive tech companies, Facebook, Google, that have responsibilities in some cases to the public and things like that. So it'll be interesting. I think that this has been, I wouldn't say a fear, but this has definitely been something people have seen kind of coming down the pipeline potentially, that maybe these companies will need to be broken up or have other regulations put on them. And I know it's been one of the few bipartisan objectives, if you will, by Congress is going after some of these bigger tech companies. So yeah, no surprise, but it'll be interesting to kind of see. I'm sure Google's going to fight it to see kind of what the overall outcome is.